Hi guys, and welcome to our podcast. Today we're going to discuss about 401k. What is it and how does it work? Within the USA, a 401k plan is the tax-qualified defined contribution pension account defined in subsection 401k of the Internal Revenue Code. Beneath the plan, retirement savings contributions are provided, and every now and then proportionally matched, by way of an organization, deducted from the worker's paycheck before taxation, therefore tax deferred until withdrawn after retirement, or as in any other case accredited via relevant regulation. In addition, it's limited to a most pre-tax annual contribution of $18,000 as of 2017. So what is 401k? By means of definition, a 401k plan is an arrangement that allows a worker to choose among taking reimbursement in cash or deferring a percentage of it to a 401k account under the plan. The quantity deferred is normally no longer taxable to the employee till it is withdrawn or dispensed from a plan. But if the plan permits, an employee can make 401k contributions on an after-tax basis. Those accounts are called Roth 401ks, and those quantities are normally tax-free whilst withdrawn. 401k plans are a form of retirement plan known as a certified plan, which means that this plan is ruled by way of the rules stipulated in the Employee Retirement Income Security Act of 1974 and the tax code. Certified plans can be divided into distinct methods. They may be either described contribution or defined gain pension plans. 401k plans are a type of described contribution plan. Because of this, a participant's stability is decided by using contributions made to the plan and the performance of the plan's investments. The employer is typically not required to make contributions to the plan, as it's commonly the case with a pension plan. But many employers pick out to inshape their employees' contributions as much as a sure percent, and or make a contribution below an income-sharing characteristic. For associated reading, see the demise of the defined benefit plan. With the 401k, you control how your cash is invested. Maximum plans provide a variety of mutual funds composed of shares, bonds, and cash market investments. The most popular option has a tendency to be target date price range, a mixture of stocks and bonds that progressively emerge as greater conservative as you attain retirement. Even as a 401k, you have lots of restrictions and caveats. In maximum cases, you cannot faucet into your organization's contributions right away. Vesting is the quantity of time you need to work for your company than having access to its payments for your 401k. Your payments, however, vest at once. It's an insurance in opposition to personnel leaving early. On top of that, there are complex guidelines about when you can withdraw your cash, almost the same as traditional IRA withdrawals conditions, and high-priced consequences for pulling funds out earlier than retirement age. Now let's discuss about contribution limits. For 2017, the most amount of compensation that a worker can defer to a 401k plan is $18,000. Employees age 50 or older by means of the cease of the 12 months can make additional seize-up contributions as much as $6,000. The most allowable employer-employee joint contribution restriction remains at $53,000 for 2016 and $54,000 for 2017, or $59,000 for those age 50 and older. The company factor consists of matching contributions, non-elective contributions, and or earning sharing contributions. A great question is, how much to put? With that settled, how a good deal must you put in? As a good deal is feasible, being conscious that you'll want to have enough cash to stay, devour, and pay down any debt you've got. At least invest sufficiently to get the full matching quantity that your company pays to match your contributions. You don't want to leave free cash at the desk. Nearly every plan offers matching finances, the maximum popular being 3% of your profits, in line with the Earnings Sharing / 401k Council of America. So, how would a 3% match work? If you put in 3% of your $60,000 income, or $1,800, your company puts another $1,800 in the pot. You can add in an additional $1,800 yourself, however, the company won't match beyond 3%. The policies for matching budget vary, so make sure to test with your organization about qualifying for its contributions. The IRS mandates contribution limits for 401k accounts. For 2007 and 2008, the maximum you can place into your fund is $15,500 in any contribution of pre- and after-tax dollars. In case you're above 49, you could kick in another $5,000. The entire dollar amount that may be contributed together with each of your contributions and your employer's can't exceed 100% of your earnings. Many employers will contribute into 401k plans for you. There are three principles of employer contributions: matching, non-optional, and profit sharing. Employer contributions are always pre-tax. This means that whilst they may be withdrawn in retirement, they will be taxable at that point. Another important aspect is matching. With an ideal contribution, your employer simply places cash into the 401k plan if you are setting cash in. For example, they will match your contributions dollar for dollar up to the first 4% of your pay, then 40 cents on the dollar for the next 3% of your pay. In our example above, if you had been contributing 5% of your $60,000 profits, or $3,000 a year, your business employer could be contributing $3,120. They would suit the first 4% of your pay, or $2,400, by means of placing in $720. On the subsequent 1% of your pay, $600, they could be matching 50 cents, or $300. As a consequence, the overall they contribute on your behalf could be $3,420 for the year. If your employer offers a matching contribution, it makes sense to make enough contributions of money to obtain the match. Consider it as an immediate raise. Non-elective is another parameter to consider. With a non-obligatory contribution, your employer may also determine to position a hard and fast percentage into the plan for every person, irrespective of whether the worker is contributing any from their own money or not. For example, an employer may additionally contribute 2% of the pay to the plan every year for all eligible personnel. The last topic you have to know is profit-sharing contribution. With a profit-sharing contribution, if the employer makes an income, they will select to put in a fixed dollar quantity to the plan. There are extraordinary formulations that determine how a good deal can reach whom. The most common method is everyone receives an income-sharing contribution proportional to their pay. Now, when do I pay tax on a 401k? When you ultimately make withdrawals from a conventionally described contribution plan, you should pay regular income taxes on the cash you withdraw, whether or not the cash came from your contributions, dividends, or capital gains. For classical plans, you'll owe income tax on all your withdrawals, both the money you contributed and the gains in your contributions. Remember, cash you withdraw from a defined contribution plan is usually taxed at your profits tax-free at the time you withdraw it. The current top income tax rate is 39.6%, even though it is feasible that the rate may be changed down the road. Within the case of a Roth 401k, you'll have to pay tax to your contributions. However, you may not be taxed later when you make the withdrawals. What if I need money before I retire? Normally you need to hold the cash within the plan until you attain age 59 and a half. Withdraw any of it earlier and then you may be hit with a bruising 10% early withdrawal penalty on top of the everyday income tax that is due on withdrawals from all traditional described contribution plans. Dreadful concept. There are exceptions, but the IRS waives the 10% penalty for positive destitute withdrawals. Each plan's regulations vary. Take a look at yours to make certain. However, you will be capable to take your cash out of your retirement account, penalty unfastened, earlier than the age of 59 and a half if you use it for charges after the onset of an unexpected disability or for unreimbursed clinical expenses that are extra than 7.5% of your adjusted gross earnings, 10% if you're below the age of 65. Do not expect it though. This money is locked up till your retirement for a superb purpose. If you spend it now, you threaten to jeopardize the financial safety whilst you're older. In case you cannot get the cash elsewhere, your satisfactory choice is probably a mortgage. Many described contribution plans will let you borrow in opposition to the amount of your account. You have the money for your account within a hard and fast duration, typically some years, or the mortgage is treated as a withdrawal, meaning you'll owe taxes and a 10% penalty on it. There are three major drawbacks. The first drawback is litmus for higher income earners. For maximum rank and report employees, the dollar contribution limits are high enough to allow for okay ranges of earning deferrals. But the dollar contribution limits imposed on a 401k plan can be a handicap for personnel who earn numerous hundreds of thousands of dollars a year. An employee who earns $750,000 a year in 2017 can best include the primary $270,000 of income while computing the most feasible contributions to their 401k plan. Employees have the choice of providing non-qualified plans, such as deferred compensation or executive bonus plans, for these employees, so one can allow them to keep additional earnings for retirement. Another drawback is the fees. 401k plans charge expenses for administrative services, funding control offerings, and once in a while, outside consulting services. They can be charged to the employer, the plan contributors, or the plan itself, and their expenses may be allocated with per participant basis in line with the plan, or as a percent of the plan's assets. For 2011, the common total administrative and control fees on a 401k plan turned into 0.78%, or approximately $250, in line with a participant. The United States Supreme Court ruled in 2015 that plan administrator could be sued for excessive plan expenses and charges in Tibble v. Edison International. In the Tibble case, the Supreme Court took strong issues with the massive company placing plan investments in retail mutual fund shares rather than institutional class shares. Risk is another thing we should take into account. Unlike defined advantage ERISA plans or banking group savings money owed, there's no government insurance coverage for assets held in 401k accounts. Plans of sponsors experiencing financial problems every now and then have investment issues. Thankfully, the bankruptcy guidelines deliver an excessive priority to sponsor funding legal responsibility. In transferring among jobs, this needs to be a consideration by means of a plan and player in whether to leave assets inside the vintage plan or roll over the property to a new organization plan or to an individual retirement association, an IRA. Expenses charged by using IRA companies can be notably less than expenses charged by using organization plans and typically offer a far wider choice of investment mechanisms than corporation plans. That's it for now. On our website, you can find more posts as well as savings calculators and other financial tools. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your thoughts, so feel free to share them on the comments below.